Hello, this is Vance, and this is Thursday, January the 18th, 2018. I'm going to do something a little bit different. I mentioned this yesterday. What I have loaded on here was a demonstration trade that I took, and I wanted to show the setup. I wanted to show the risk-reward ratio of why I took this trade, and all the other things as far as when I move with targets, where I move the stops, and to talk about initial risk, current risk, and try to give a description of those things while the trade is taking place. Now, this trade is already done. It's already finished, and I had to wait for a trade. It did go to completion, right to the 64.17. But I'll tell you why I took the trade and how, I don't know the trade is going to go all 445 ticks. I don't know that. But what I did reason out is that I'll show you the number of the reason I took the trade. I'm not going to talk about the entry and so forth. That's a different lesson. This one is just about the risk reward ratio and to try to describe of why I do what I do with regard to the three lots. And I thought this was a good example to use to try to describe that. So hopefully it'll make some sense to you, and we'll go from there. Anyway, so let me go for that. I'll go ahead and I'll run it. I recorded this, and I'm going to run it, and I'm recording it again just to kind of give you the description so I can stop and start it and give you some explanations. So let's go here. All right, here we go. The entry point was at 63.72. And when I put it on 63.72, just forget the little dot that's running. I'll have two of these things running at the same time. So I will kind of highlight it on when I do the edit for this to kind of give it some idea. At 63.72, the reason I got into this trade was because of the fact that I saw my 15 ticks was really at 63.57, and you can see that I had drawn on this line along the bottom here at just around that 63.57 mark. The 63.57 mark was where I thought the prices was really conglomerating at or where the support was, and we'd already had a run up above the 63, my entry point. After this strong bar, you can see where the dip is. I have this light line in here where I thought was a secondary support. So price came back down here. It bounced off on the strong bar, and I was able to limit in at 63.72. Now, my initial risk on this particular trade is one. The risk, if you consider one, my risk is 1 to 2. And the reason the risk is my initial risk is 1 to 2 is that and I'm going to eliminate the commission at this point in time. But if you take a look at where my 15 ticks is, it's 3 contracts or 3 lots, 15 ticks each. That's 45 ticks. If you look at if the contracts go to completion, we have first contract is 15 ticks, second one's at 30, the third one's at 45. You add those up, and that's 90 ticks. So you have 45 tick risk, 90 tick reward, which is, if it goes to completion, is 1 to 2. Okay, so that's a 1 to 2 risk reward ratio. The problem is that when people talk about risk reward ratios, they always talk about it in stagnant form. In other words, this is the risk reward ratio, and that's why I got in this trade. I'm looking for 1 to 2 or 1 to 3 or whatever it may be. The challenge with that is that in the initial risk is, in this case, is 1 to 2, but the actual risk or the actual risk will be dynamic. It changes. So as the trade progresses, as time goes on, the initial, let's call the actual risk or the current risk, is going to change. So if you look at it from that perspective, right now I'm ahead on this particular trade. Entry 72, it's at 76. So if it's at 76, that means that I'm ahead 5 ticks, which means that now at my current risk is higher than that because you add the 15 ticks plus whatever it is ahead. If it was down, it would be different as well because now my risk reward ratio has changed. The problem is that that recalculation of change in risk happens on every single tick. And so to continually make that recalculation based on that, it's really not only difficult to do, but I don't think it's really necessary. Maybe computers do it. I don't. I mean, I'm not a computer. So if you look at it from that standpoint, right now I'm still at my initial risk is still the same, but my current risk has changed. Now, what warrants me changing my current risk? Only I make the change as when my first contract comes off, and I'll show you that in a second. Okay, so keep in mind that the initial risk is 1 to 2. Let me just fast forward this a bit. Okay, my first contract came off, took me at plus 15 ticks, and I moved my stop to break even. Okay, and I kind of moved up a little bit higher after that, like break even plus 5 or anything else. But let's call it a break even. At that point, if I leave it at break even, let's take a look at what my current risk is. Remember, my initial risk is still the same, but that's now gone by the wayside. What is my current risk? Well, my current risk is if it's took out the first contract, at the first contract is at 87. That's where I got my first contract off. Right now, my current risk is whatever those next 2 contracts are to take off minus what I will give back if it comes back and takes out my stop. Now, if I was continued at break even, that means that my current risk would only be 1 to 1.5. And why I mean that is that if you look at it from the standpoint of if the price of the money that I have is already in pocket, in other words, I'm still 15 ticks ahead at my first contract. If it comes back and takes me out, it's minus 30 ticks. But if it goes and completes the next 2 contracts, that will be plus 45 ticks. Therefore, my risk reward ratio, my current risk reward is 1 to 1.5. Okay, I hope that makes sense. So now my current risk is 1 to 1.5. Now let me pause that and I'll just go fast forward this for you. Now in this actual trade, I moved it up plus 10 ticks. And so now I'm plus 10 ticks on this one. Okay, so now I've got basically 20 ticks locked in. At any given point, and let's assume that for a moment that it's at 94, it's 92. Right now, this risk-reward ratio has again changed. The minimum is at 1 to 1 because, risk-reward ratio, because now this is ahead. My first contract is ahead by roughly 10 ticks, but my loss would be minus 10 ticks. So I'm right in the middle between these two. As you can see, again, my risk-reward ratio has changed because now I've moved up I've locked in some more contracts. I've taken some risk off the table, but my current risk is I'm still keeping at that 1 to 1 point. In this case, 1 to 1.175. Okay, now my second contract got taken out, and I moved my first contract up to break even or to plus 15 ticks, which means that at that level. At that very level, second contract was taken out at 64.02. At 64.02, I'd have a 1 to 1 risk reward ratio on that last contract. Okay, so it's still 1 to 1 risk reward ratio. The point is that if it goes in completion to 84.17 and my contract is at 63.87, that means I'm a 1 to 1 risk reward ratio. However, from my initial risk standpoint, I'm now in the block by a reasonable margin. So I've got like my first 2 contracts are off, and on my initial risk, what I'm at on my initial risk is a 1 to 1. So this trade is successfully 1 to 1 at this point in time. What I mean by a 1 to 1, so my first contract off is at plus 15. My second contract off is at plus 30. You add those 2 together, that's plus 45 ticks. So my initial risk was minus 45 ticks or 45 tick risk. So now, right now in this position, I had that trade is a 1 to 1 trade. But my current risk is still 1 to 1 because if it comes back and takes me out at 87 before it gets to me before it gets to 17, that means that would be a scratch trade on the current risk. If it goes to completion to 17, that last portion of my trade is going to be 1 to 1. Now I moved it up a little bit, trailing it behind. And as you can see, it'll take out this other contract here. We'll just I'll fast forward that one. Now for trailing, a contract, I usually like to try to keep it near that 1-to-1 risk reward ratio. So if it's 10 to target, I like to trail it by about 10. That's usually what I like to do, depending on the structure of the market. In this case, that's what I was approximately that area. Plus, in this case, I was plus 97 at 64.07, and the contract was at 64.17. So my expectation is that it's going to hit the target before it hits my stop, with the extension of like plus 45 ticks. If it hits it, then that would have been a good trade, which in fact it does right here. From there, it didn't go up much more. And in fact, it kind of turned over, and it really worked out well, because from there it kind of moved back down. Just worked out all the way around. So as you can see, that's the way I calculate that out. But I thought this was a good way to describe the risk reward ratio while one was in a trade, to kind of give you an idea of what I'm thinking when I initiate the trade. Hopefully this is helpful. Okay, well, that's it for now. This is Vance. Thanks for watching. Bye for now.